Okay, folks, can you hear me? Okay. I'm going to try. The only way I can check to make sure I'm being heard is if you guys settle in, right? My wife used to teach first grade, and she gave me a suggestion because first grade kids sometimes get out of control. And she said, the louder they speak, the softer you should speak. I've never been able to take her advice now because, so the first minute is always going to be chaos in this class because it's a big room. But I want to first make sure you're in the right class. It's the only class that really matters. That's my personal view. Now, even my valuation class is kind of an add-on. I'll talk about why this might be the only class you came back to business school for, or should be. Yeah. But this is my 32nd year teaching in this room. And I hate this room. First, I mean, this is the ambiance of Madison Square Garden on a bad Knicks day, right? It's not exactly a friendly room to be in. And the acoustics stink. Stink in what sense? I think you guys can hear me. When the architects built this room, they thought about that. They said there's going to be somebody at the front speaking, and everybody has to hear. You know what they did not factor in? This is what happens when you let architects build classrooms. That if you speak, other people need to be able to hear. And from that perspective, this room is terrible. So if there's a question from this side, people on that side can't hear. So I'm going to try, and I'll keep forgetting, so remind me when I forget, that if there's a question, I have to repeat it to make sure that it's in fact going to be carried to the other side of the room. Now, since we're adding up years, now as I was coming up the elevator, I ran into somebody who said, my mother was in your class. I'm getting to a point where grandparents are going to be on now. I've been teaching here since 1986. You know, in a couple of years, they're probably going to, next year, they'll give me a pin or something, which I throw away right away. The 40th year. It's survival prices. Don't, you know, I'm not that impressed. I've managed to stay around, but that's not saying much at a business school. But my very first class was in 1984 at the University of California at Berkeley. It was an undergraduate class that I remember the numerical code for the class, BA 130. It was a corporate finance class. I was terrified. I walked in. And to be quite honest, I didn't know what corporate finance was when I walked in, and I've tried to figure it out. And I think I'm a little further along the road than I was in 1984. But the core of the class essentially goes back to where I started in 1984. So before we dive into corporate finance, what it is, what we're going to try to cover in the class, there are a few logistical details. First is I do have an office. It's on the 9th floor. This building is really 3 different buildings. So there's KMEC, there's Tish. So it's in KMEC, which is the other building. So it's 969. And as you well know, these elevators don't talk to each other. So if you take the elevator in the wrong building, God help you, you're going to get lost. You'll never find. So take the elevators in the other floor, 9-69. My office hours, technically at 12 to 1:15. I'll explain what I mean by technically. 12 to 1:15, which is right after the class. So it's a good time to come and ask questions, but I am usually in my office around 9:15, getting ready for class. 9:30 to 10:15, feel free to drop by, especially if you have a quick question, you just want to say hi because it's a big class, you really don't get, drop by. And I have a fair game principle, which is if you find me, I'm fair game. Which means the game starts right now, which is for the next 15 weeks, I'm going to try to make it difficult for you to find me. No, I'm not going to try, but I'm going to take the stairs rather than the elevator. You know why? Because I know you guys never take the stairs. Do they still have those signs telling you should take the stairs? I mean, for a while they did. I think they took it down because nobody was following it. But truly, if you find me, either in person or virtually, I tend not to hang out in the social media places you might hang out. I don't live my life on Twitter or Reddit. I won't name the other places because I won't embarrass you. No, definitely not TikTok. No. But if you do find me virtually, I'm fair game too. And that means that it doesn't end after 15 weeks. You can hunt me down after 15 weeks, but then your grade is already in. So the fair game principle applies. I will also, during my office hours, turn on I've set it up for Zoom. Why? Because, I prefer that you come in physically for the office hours, but in 2020, I started the process of having just Zoom office hours. I've preserved that tradition because that way, if you have a question and you're working from home or which you shouldn't be, it's a Monday, Wednesday, right after class. But if you get back home and you want to ask a question, you're sick at home, you want to ask a question, no. The only thing is if there's somebody in my office, they get first dibs. So if you're on Zoom, you might have to wait a little bit, but I'll keep the Zoom link on. There are 2 teaching assistants for the class, Chris and Zoe. They both took the class last year. They know how much I torture you, so they're fully aware of every piece of this class. They will have office hours, but they'll also have review sessions every week. No. During the review sessions, all they will do is actually take problems from past quizzes and exams and work through them, because I'm not going to work through a single problem in class. No, it's not what I enjoy doing. It's not the best use of my time or your time, but they will work through those problems. So if you feel you need that additional help, take advantage of the review session. So more details will follow on where the review sessions are and when. Now, it's probably a little too late for preseason prep, but I did send the email out 2 weeks ago, right? And I know you haven't been reading my emails, and this might become part of a pattern. So I'll act like you read my emails, and I'll create a device. We have no excuse for saying I didn't see that email. But I suggested that there are very few things I will draw on in this class, but 3 things I would like you to bring in the class that'll make your life easier and mine too. The first is, I would say some terrible things about accountants, and I mean every word of it. But let's face it, our raw data in business comes from accounting. Does that mean you have to know debit and credit and accounting rules? Frankly, I don't know debit and credit. I couldn't care less about what accountants call it their rules, but you have to be able to tell me the difference between gross income, operating income, and net income. If you're still struggling, what's the difference? That's a signal that your accounting didn't stick. In theory, you've all taken your accounting class, right? I said in theory, I don't know how much of it stuck, But if you feel it's not stuck, and the way you'll know is when you open up a financial statement and you really get lost right away. Right after the revenue, everything else is some mysterious. No. If that's the case, I've created my own version of an accounting class, which would make an accounting professor blanch because I break every accounting rule. It's the accounting that I need for this class. So if you feel shaky on accounting and you want to revisit that class, it's 12 sessions. It's about 3.5 hours altogether. It might be an investment worth making. Second skill set is statistics. If you've taken a statistics class, at least in theory again, the tragedy of statistics classes is you forget them almost immediately after you finish them. Thank God that class is over. I will never need it again. Okay? In the old days when you had books, you could sell them back to the bookstore. This was the first book you sold back. Okay? And that's almost tragic because if you think about what we face, not just as finance people, but as human beings, we're inundated with, I won't even call it with data, right? Information. We're facing information overload. And the problem with that is you're getting pulled in different directions. You say, how do I break the tie? I have 5 different things that claim to tell the truth, but they're all telling the statistics is designed for big and contradictory data. So for not even for this class, in general, I think it's a good idea to revisit statistics and say, what can I take from the class? And you might take only 20% of the class to use to make sense of that data around me. So in corporate finance, you're going to have a lot of data coming at you. In fact, I will argue that your biggest complaint is not going to be, I can't find enough information. It's going to be, I'm finding too much information and it's pulling me in different directions. So here again, if you feel your statistics class did not stick, I've created a 12-session version of a statistics class, again, from the perspective of somebody who's not a statistics person at heart, but somebody who needs statistics in finance, in valuation, wherever I run into it. So if that's your weakest link, fix it. And finally, how many of you are taking foundations simultaneously? Okay, a few. It's not a prereq for this class, but there are a couple of tools out of the foundations class that we'll draw on. First, of course, time value of money. If you're still struggling with what present value is intuitively, I know you got the PV button worked out in your calculator or your computer, but you're still not quite sure what it means. You got to get that out of the way, right? Because finance is almost entirely time value of money. So if you feel that those very basic finance pieces are shaky, I have a minimalist foundations class looking at instruments and time value that you will lose in the class. So if it's too late for preseason prep right now, but if at any stage you find that these are the things that are impeding your progress in this class, you're getting stuff in this class, go back and revisit them. I will torture you every day, and this is a promise, not a threat, every day from today till May 5th, which is your last day of class, and probably spilling over 3 days after that, you will get an email from me. Not a text message, so I will stay with emails. And every day the email will cover something different. So right after class today, there will be an email about what we did in class today. So I was in class already. I know physically you were here, but sometimes you can take a mental break. And when that happens, you come back from that mental break and say, what the heck happened? This email might say, this is what happened, right? So it's not like a Twilight Zone episode. This is where we are. On Tuesday, which is tomorrow, you'll get what's called the corporate finance puzzle of the week. It won't start this week because we won't have done enough, but starting next Tuesday, every week, I'll put out a puzzle. You're saying, what scary thing is that? It's going to be something topical. For instance, I might say, what's a big business news that's come out over this weekend? DeepSeek, right? I mean, today the market is entirely structured around DeepSeek. So next week, my question might be, if you're in corporate finance working for NVIDIA or working for Microsoft, how does the entry of DeepSeek change your core business story? So it'll be something general where you can use the tools of corporate finance to at least start answering the questions. Something that's a news of the week that we're building around. Again, structured around what we're doing in class. On Wednesday, again, there'll be an email after class telling you what there is and essentially following up on the class. And on Thursday, I will send out an email about your project. You're saying what project? In a few minutes, I will describe what you're going to be doing through the course of this class. Your project is already started. You just don't know it yet. We'll talk about how this project plays out. And every Thursday, I will try to guilt trip you. Why? Because I know exactly what's going to happen. The project is actually not due till May 5th. I will nag you about staying on course with the project, but I know exactly what's going to happen, which is you're going to ignore my nagging, you're going to fall behind, and the 12th week, you're going to say, I have to pick a company? Yeah, you were supposed to do it 12 weeks ago. So think of this as a guilt tripper. I said, this is where you're supposed to be on the project. I'll let you fill in the gap as to where you actually are and what to do to cover that gap. On Friday, I'll do what's called an in-practice webcast. Sounds fancy, but I will take something that we do in class that say, go get that, and you say, where the heck do I get that? This will take you through the process. So for instance, we'll talk about risk-free rates in a couple of weeks. How do you get a risk-free rate in Indonesian rupiah? We'll go through this in class, but then you'll say, where did he get the data? How did he build it up? The webcast will take you through the grunt work of collecting the data so you can estimate a risk-free rate in Vietnamese dong or Indonesian rupiah or Brazilian reais. On Saturday, there will be a newsletter. What news? Not much news, but basically to tell you this is what we did last week. You'll notice a lot of revisiting and part of the reason for that is in a big class, you can get lost, especially as you get to the middle of the semester and things get busy. Think of this as a GPS saying, this is where we are in the class. This is the page we are in the lecture notes. So the newsletter is really about grounding you in where we are in the class. So if you get lost, you can say, okay, I can see where I need to get. On Sunday, there'll be a newsletter saying, this is what's coming in the next week. So you're ready for the classes for the week. So this process will play out. I have the tendency to send really long emails. I would say I'm sorry, but I really am not. So I'll act like I'm sorry, but I'm not, because in the emails, I'll throw in things that I've been reading saying, hey, think about this in the context of what we talked about in the class today. Now, in terms of class rules, there are very few. I'd like you to be here. You think, where else would I be? I will make it easy for you to not be here. And then I will ask you to be here. In what sense? Every session is going to have a Zoom link and be recorded. That way, you have no excuse for missing the class. You can be in whatever part of the world. You'll have to get over the time difference, but you can watch the class. If you can't watch it live, you can watch the recording. And some of you will be tempted around the second or third week because you're sleeping in. You think sleeping in at 10:30? Hey, people are capable of sleeping in till 2 o'clock. My son, yes, I was supposed to meet my son for brunch yesterday. We had brunch at 3 o'clock. I said, call me when you wake up. He's now is out there, but basically, whatever he does on Saturday night clearly spills well over into Sunday morning. But he called me at 2 o'clock, said, Dad, I just woke up. I said, okay. I kind of planned for this. Brunch becomes dinner becomes dinner. God only knows what meal you're eating, but it doesn't really matter. So if you will be tempted at points in time saying, do I really want to put my clothes on? Can I stay in my pajamas all day? Maybe I can just do this. I would like you to be here. Obviously, it's better to be here on time. But if we can make it 30 minutes late, I'd rather have you here 30 minutes late than not at all. But if you cannot make it, you're sick, God's sakes, don't come in with COVID or the plague or into the class. I don't want you physically sick. Stay at home to watch it. But if you cannot make it, you'll be able to keep up with the class. All you need to bring to the class is the lecture note packet. And of course, if you have an iPad or a regular computer, you can download the digital version. I'm not going to cause the rainforest in Brazil to shrink because I want to teach this class. If you feel you need a physical copy, by all means, print out the packet. Just don't do it on the printers downstairs, because then I will hear about it, because you print what, 450 pages and times 250 people. You'll kill the printers and then they'll reach out to me. And I'd prefer that not happen. So if you're working somewhere part-time, print off their printers. I don't care, right? Ruin their printers. So if you do miss a class, catch up on the class. Don't let it go too far behind. I know there's Brightspace. I never use it. I get on there because I'm supposed to, and they harass me if I don't. And then it just sits out there. I don't like closed learning systems. I didn't like what preceded. This is the 5th or 6th learning system that NYU has used. I've ignored all of them. Brightspace will have its uses because the grades will obviously be easiest to check there. So you will see your recorded grades. If you forget what you got on a quiz, you can go look it up there. But almost everything that happens in this class will happen through the web page for the class. And that link is right there. I've sent it a couple of times. So think of that as the platform for all of the material for the class. There is a YouTube channel that will carry the lectures. It'll also carry all the in-practice videos. So basically it's there. What is that for? While you're taking this class, I think this semester there are 10,535 people who will also be taking the class unofficially for no credit and no payment, But they'll be watching just the YouTube videos on there, and they won't, obviously they won't be dropping in on office hours or hacking the Zoom session in live. But the YouTube channel basically will have all of the sessions. Remember I talked about an email every day? you will at some point in time probably block me. Why? Because I'm, killing your mailbox. And then you will, when I talk about, remember that email I sent last week, you're going to say, what email? I'm going to take that excuse away as well, because every email that I send you will go into what I call the email chronicles, which is going to be classified by date. This is the email. So you have no excuse for saying, I didn't see that email. It's there in the chronicles. So if you don't check your emails, because that's not what you do, the chronicles will carry it. Few more logistical details. The class is obviously on Google Calendar, so you can see when the quizzes are. There is zero flexibility in terms of moving quiz dates. I'll talk about what will happen if you have to miss a quiz, which I understand can happen. Part of the reason I have 250 people, I can't afford to have too many moving pieces. Things start to blow up on me. So the Google Calendar will tell you. I think the final exam date is finally out, so I'll put that up as well. But that's going to list out the dates for the class. No, I do have this blog where I dabble. I dabble in things that interest me. So it's really about me. I'll write about whatever interests me. And maybe some of the things that interest me will interest you as well. You've seen the first 3 data updates I sent for this year. I sent the links. If you get a chance, read them. You don't have to be a finance person. The first data update basically is about how I update the data. The second is about what US equities did in 2024. The third is about slicing and dicing the equities with sectors, with industries, market cap, price. Basically all the different ways you can slice and dice. But no, I am already pondering a piece on DeepSeek and saying, how does DeepSeek change the value of companies? Which companies are going to be most directly impacted, which are indirectly impacted? What does this all mean for that AI hype, hope, whatever you want to call it, that's been driving markets for the last year? I do have a Twitter feed, and it's all about numbers for me. My end game in life is to always have more people on my social media platforms than my kids collectively do. So I just, So what I'm saying is if you have 4 email addresses, put them all on Twitter and put them down as followers, I can take 4 over 1 every single time. But, it's basically, I use Twitter not to have online debates or discussions. I've never, ever responded to a tweet because bad things happen when you do. But it's my announcement device. It's very effective at saying, I just posted or I just put the data up and then I leave it alone. But if you want on-time announcements that something has come up, that's a new data item, this is where you find it. In terms of required material, the only thing you need is the lecture notes. If you feel that a book will help, there's actually a book that parallels this class called Applied Corporate Finance. It's a book that's in its 4th edition, and basically everything you see will be in there. So it's supplementary. You don't need to use it because it's obscenely overpriced. I would not buy my own book, and I can't in good conscience ask you to buy the book. But if you feel wealthy, I don't know what that means, right? How you feel wealthy with the tuition we charge you, I don't know. But if you do still feel wealthy and you have excess cash, and by all means, buy the book. Practice prompts. There will be practice prompts at every exam and quiz I've ever given in a corporate finance class, which goes back, I think, to 1986, is online. You want practice quizzes? You'll have more practice quizzes than you ever wanted to see. This is actually a curse, not a blessing, and you will see very quickly what I mean by that as you start approaching quizzes. But every exam and quiz I've ever given is online. You can find it. And along the way, whenever you use a model or data, you're going to see it online as well. So logistically, the class is structured to be almost a class you can take sitting in your bedroom and never leaving it. So if you have some strange mental problem, you cannot leave your room, you can still finish this class. Okay? Let's talk about this class. What is corporate finance? Anybody want to give that a try? What is corporate finance? Before I jump in with my definition. Let me back up. How many of you have taken, I should have done this right off the top, an undergraduate corporate finance class? Okay. How many of you are finance people? You worked in some kind of a finance job. It could be banking, it could be consulting, it could be in a corporate finance. How many of you are finance people? Okay. I want everybody in this class to look around. This is not 1986. In 1986, if I'd asked that question, or even in 1995, the vast proportion of this class, at least at Stern, would have been bankers coming back for rehab. Right? I mean, basically, you spent 2 years in banking, you came back. This was like a conduit. So this class would have been recovering bankers coming back to say, I really don't want to recover, but they kicked me out anyway, right? This is a very, very diverse class. Many of you have not just not worked in finance, this might be the very first finance class you're taking. But among the people who took corporate, and it also means that you don't use the excuse of, I'm not a finance person. I'm not going to let you get away with that excuse in this class. I will make you a finance person by the end of this class. I'm a bit of a televangelist on this dimension. My idea of this class succeeding is at the end, you say, I see the light. I'm no longer a marketing person. I said, thank you, God. Right? But if you've taken a corporate finance class, you should be able to answer the question, right? You could an entire class with this title. What is corporate finance? Anybody want to try? Come on, I'll make you look good. Even if you give me the wrong answer, I'll reframe it to make it the right answer. I'm very good at that. You said you'd taken a corporate finance class, right? You took a corporate finance class? Okay. One of the problems with this room, and I apologize for this, is there's no place to put your nameplates. Okay. And it's awkward for everybody to say, I am so-and-so. So if I say you, it's not because I don't see you. It's because I really can't see your name. So what's your name? Jose? What exactly do you think corporate finance is? Interpretation. Is it just interpretation though? We sound like psychics then, right? It has to be more than it has to be, something that covers the actions of a company, you said? That's interesting. What kinds of actions are we talking about? All the action, not just the financial actions. Because the reason I ask this question is, at least in New York, the definition of corporate finance gets really cramped because it's set by what investment banks call corporate finance. What do investment banks call corporate finance? Usually the interaction between firms and financial markets. That's where investment banks come in, right? Which is, are you raising capital? Are you doing a deal? Calling that corporate finance is like a podiatrist claiming to be a general practitioner. You're looking at toes all day. You're really in no position to tell me what the rest of me looks like. It's a very narrow vision of corporate finance. So I'm going to give you my definition of corporate finance. It's incredibly self-serving. I asked you how many of you are in finance. You know what? Every one of you has been in finance. You just didn't know it. Corporate finance covers any decision made by a business that involves the use of money. You're in marketing? You don't think companies spend money on marketing? You're in HR? You don't think money gets spent? If you spend money, it's a corporate finance decision. You see how incredibly self-serving this is? Do they still have that orientation for first-year MBAs where they make you come in a week before class starts? And then they try to tell you that everything you know is worth nothing and that the next 2 years is what matters. It's complete brainwashing. And I've never really wanted to be involved in that process because you make false promises that you can't deliver. But about 7 or 8 years ago, they made the mistake of inviting me to talk to the orientation class. Why? Because this has become a rite of passage for Stern MBAs. This is an elective, and for some reason, it's an elective that draws a big chunk of the first-year MBA class. They said, can you come in and talk to these entering MBAs about what your class is about? So I went in with a chart, and I don't think they're ever going to invite me back again. I said, this is what the MBA program looks like. There's my class. And then there are all these other classes you're going to be taking that are in service of my class. They just don't know it yet. I'm going to argue that everything you do is going to feed into my corporate finance class. Your strategy class is going to lay out the foundations for my forecasting what the future is going to be in terms of revenues and margins and cash flows. Your marketing class, your accounting class, every class in a sense is a piece of this class. So whatever you choose to do, this class is going to follow you around and perhaps haunt you. It is every single thing in a business is corporate finance. So I'll lay out the objectives for the class, and then I'll try to use the rest of this class to flesh out the objectives. So you asked me to describe this class. First, it's a class that is applied. What does that mean? When I first taught corporate finance, I was given a syllabus to teach. The syllabus, of course, like every discipline, includes all the things that are supposed to be taught in the class. And the first semester I taught it, I had no choice. I taught the syllabus that was essentially corporate finance syllabus in every single class with the textbook that went with it. And then I started asking the question, why do I need to know this? Or why does somebody in this class need to know it? So I started applying a very simple rule that started to prune my syllabus. I said, if it cannot be applied, I don't care. And if I don't care, why should everybody else care? So I went through the syllabus, taking out things that were supposed to be there that I could see no way of applying in the real world. What's left in this class, or what the version of the class you see is my version of corporate finance, which is about, hey, if I can't apply it, I can't use it. Everything in this class is going to be applied. I'm going to peripherally again reference your project. You're saying, what's a project going to be about? You're going to pick a company, and everything we do in this class, everything, you're going to apply on that company. And if you can't apply it, I'd like to know, because I'm going to take it out of the class if it cannot be applied. Second, this is a big picture class. By now, even after your first semester, you probably become a little cynical about the word big picture, because every class claims to be a big picture class. I'm going to show you the big picture on the next page of corporate finance, and I'm going to stay true to that big picture. Everything we do in this class is somewhere in that big picture. Third, and this is going to sound a little sick, I think corporate finance is fun. It allows pieces to fit together. What I'm looking for are what I call aha moments in this class, where something connects for you, but something you've never been able to quite understand. Why is NVIDIA worth 4.3 trillion? Or why do companies buy back stock? Are buybacks a good thing or a bad thing? Maybe at some point in this class, you will at least start to get the pieces of understanding why companies do what they do and why they sometimes do stupid things. So I've laid the objectives. In the very last session, I'm going to come back and revisit those to see if I've delivered. So on May 5th, you'll see that same page pop up with a very different end game. Did we get that done? So let's start by first getting you out of what I call the accounting mindset. Now, to the degree that the accounting class at least partially stuck, I'm going to take you through an accountant's favorite financial statement. Only accountants love this statement, but we'll talk about why. And as I go through this, you're going to get a little perspective on how accountants think about the world and why you need to snap out of it. If you're an accountant, my condolences. You spent a lifetime getting here, so I'll have to slap you. It's more, in fact, I have more work in this class, getting the class through to accountants than any other subgroup, and we're going to see why. Let's take the accountant's favorite financial statement. If you step back, there are three core financial statements, right? Anybody want to name them? Go ahead. Exactly. Income statement, and tell me at least in broad terms what each is supposed to do. What's the income statement supposed to do? Or made, not made, because it's always backward looking, right? Made. So it tells you how much the company earned, which is a big deal. What is the statement of cash flows telling me? So basically it's like looking at a checkbook. How much cash came in, how much cash went out, what's left, and what's the accounting end game with the balance sheet? what you own and what you owe, right? That's basically what each is supposed to do. Let's not dress these up as more glorious than what they're supposed to be. So at least in theory, a balance sheet is supposed to show what a company owns, what it owes, and you say, what about the difference? That's what your equity is supposed to be worth as a business. Let's go through an accounting balance sheet, because along the way, you're going to see the inconsistencies that are built up in accounting as we know it, and why the accounting balance sheet has less and less value in it. And I'm using the word value deliberately here. So let's see how much of your accounting stuff. If you look at accounting balance sheet, broadly speaking, there are 4 classes of assets. You have long-lived physical assets, land, building, equipment, machinery. Accountants are big on tangible versus intangible. We'll see why that is, but if you can see it, it's no. If you have long-lived physical assets, like factories and equipment, and you see a number in an accounting balance sheet, I'll stay with you. How do accountants come up with that number? Let's take a plant or equipment. Somebody want to help him out with physical real assets. What is the rule in much of the world still? It's what you paid. Mark to market has not migrated there, right? So it's what you originally paid for something, but that's not the number you see. So what's happened to it while it sat there? It's been, why at least accountants say it'll probably get less valuable over time. So it's what you originally paid. Already you can see the first problem here, right? If I bought a building in New York City in 1965, and I see the building on my balance sheet, what's going to be true about the number you see there? It's going to be completely disconnected from reality. But it's accounting. Stay with the accounting mindset. We'll snap out of it because it's very dangerous to stay there too long. That's physical assets, land, building, equipment, machinery. Then you've got short-lived assets. What are those? Inventory, receivables. It's usually under the current assets column. Here, it's still what you originally paid for it, but it's usually not that different from the current value. Why? Because hopefully your inventory hasn't been sitting in your storeroom since 1965. In which case you're probably done as a company. It's probably 6 months old. So here it's still what you paid for it, but it's closer to current value. Then you've got investments in other companies, and here accountants are all over the place. Let's take Microsoft. What's its most high-profile investment in another business? OpenAI. They've invested $14 billion in OpenAI. So if I went to the Microsoft, and at least till Friday, OpenAI was presumably worth a lot of money, and we'll talk about what's happened since. But if I went to Microsoft's balance sheet, what am I going to see as the value of OpenAI? That 14 billion that they invested. It could go to 100 billion, 200 billion, but it doesn't get marked to market because it's classified as a strategic investment. That Microsoft did this, and it's true, right? They did this because they want to build OpenAI into their products. So if you have a cross-holding in another company or another business or an asset, and it's to help your core business, it'll be recorded at what you originally paid for it. And the disconnect from reality there can be immense. I remember valuing Yahoo in 2014. In 2014, what was Yahoo's business? A search engine that nobody searched on, and in a mail program that I think only people over the age of 75 had heard about, Yahoo Mail. So I valued the business, being as generous as I could. I came up with a value of $4 billion. The stock was trading at $39 billion. You're saying, that is weird. You know what explained the difference? It was actually not, it was not overvalued. What did Yahoo own that wasn't caught in the $4 billion? They owned pieces of 2 companies. One was a company called Yahoo Japan. That's a standalone publicly traded company. And for some reason, the Japanese still like Yahoo search engines. Don't ask me why. So it was worth about, at that time, 35% was worth about $10 billion. And the other was a 21% holding in a Chinese company called, wrong Chinese company, try again. So you're very close. Alibaba. You know how they got the 21%? They were a venture capital investor in Alibaba and they invested about $1 billion. Best thing Yahoo ever did, right? Because by 2014, Alibaba was on the verge of going public. And if you remember, it went public at 200 billion. What's 21% of 200 billion? It's not a trick question. It's 40 billion plus. If you looked at Yahoo's balance sheet, that Alibaba holding was recorded at less than $500 million. You think that is weird? That's what they originally invested as a VC. So with cross holdings, you can see that some cross holdings are going to bear no resemblance. But if you open up a SoftBank and you look at its holdings in, I wouldn't say WeWork, that's too much of an open wound to pick at. But you look at its holdings of Alibaba, which is, and SoftBank is also a big investor in Alibaba. What are you going to see? Because SoftBank is a VC company, viewed as a trade, it's viewed as holding its investment for trading. It has to mark to market. He's saying this is a mess. I agree. So when you look at a financial balance sheet and you look at holdings in other companies, you might have to dig through the footnotes to see what those recordings are, because it could be marked to market, it might be recorded original cost, it might be adjusted for book value, it could be all over the place. When accountants claim to be consistent, they're lying. Call them out. There's no consistency in this process. And then you get to intangible assets. Let's start with a generic question that has nothing to do with accounting or finance. Are there companies out there that get the bulk of their value from things you can't see? Take the 7 largest companies in the world. They're the Mag 7, right? What's Apple's biggest asset? It's not the physical plants. It's everything, right? The operating system, the styling. Remember, they're John Ive, legendary stylist. This is a company that actually thought about styling. So when you look at your iPhone, you're seeing the results of tens of millions of dollars. Should the edges be, curved, or should they? You think that is such a waste? They clearly don't think so. Intangible assets. What's Google's biggest intangible asset? Again, not that stupid campus they built in California. That's a playground. It's a search box that we still go to when we want to find things, whether we trust it or not. You take the Mag 7. Maybe Tesla might have some physical assets, that Fremont plant and the plant, the 4 other plants they've added on. But for all of these companies, the bulk of the value comes from things you cannot see, intangibles. So let's start with an acceptance. You look at the big companies of the 21st century, most of their value comes from things you cannot see, intangibles. So you know what? The last 30 years, accountants have been wrestling with how to bring intangibles on. The amount of time and energy they've spent trying, it's called fair value accounting, which is an oxymoron, because you can either do value or accounting, but they keep trying. The end game is you want to bring intangible, and it's a worthy mission, right? And given how much time they've spent and how much they talk about it, you think they must have done a pretty good job by now. So at the end of 2024, I took every balance sheet in the world. It's easy to do now. The data is there, Capital IQ, you can download the balance sheet. I added up the intangible assets on all accounting balance sheets. Big number. It's gone up a lot over the last 20 years. You think, great, accountants are finally catching up. But here's the problem. 85% of those intangible assets still come from one item. Now, what that one item is? It's the most destructive accounting item ever created. It's called goodwill. And here's why I call it the most destructive. I mean, if you worked at KPMG or Ernst & Young, this was your mother's milk in terms of how your business ran, right? Because you were called in to assess goodwill, and then every year you're called in to impair that goodwill. This is like a continuing business model for you. I'm cutting at the heart of your entire existence, but I'm going to do it anyway. Here's why it's the most destructive and meaningless asset of all time. For goodwill to manifest itself on an accounting balance sheet, what does a company have to do? buy another company. So already you can see the basis for the problem. If you're the greatest company in the face of the earth, but you've grown entirely with organic investments, there will be no goodwill on your balance sheet. Take a look at Apple's balance sheet. You know how much goodwill there is? Almost nothing. Why? What is the last big acquisition that Apple did? Beats? That was like petty cash. This company has never done a big acquisition. If you don't do a big acquisition, there's no goodwill. Conversely, if I go out and acquire a company, let's play a game. So let's say you go out and acquire a company for $10 billion, right? How do I measure goodwill? What is it? It has to be the difference between two numbers. What is it what are the two numbers that are used to get goodwill? What you paid as a purchase price, and let's see how much accounting brainwashing you've gone through. What's the other number? So the purchase price is observable. What's the other number I compare it to? Let's keep the liabilities out, but let's at least, but what number would I put to those assets? If you've taken an accounting class, you're told it's the fair value of those assets. There's nothing fair or value about it. I live in the value domain. To call that fair value is, I think, an insult to both words. It's accounting book value dressed up. So here's what happens. After you do an acquisition, a team from Ernst & Young shows up at your offices. What do? They do a 3-month elaborate kabuki dance. So what's this, see that? And after 3 months, they say, we've done an assessment of your assets, and it looked like the value that you had 3 billion is wrong. It should really be 3.13 billion. They'll add more decimals to show that they've done a lot of work in the 3 months. But it's book value dressed up. Dressing up book value is like dressing up a turkey. It's tough to hide that scrawny neck, right? But you dress up book value, you come up with this number. You got a $10 billion purchase price. You got a $4 billion dressed up book value. As an accountant, you got a $6 billion problem, right? To explain away why. Because until yesterday, you were telling me the company was worth oops, it's worth 10 billion. So what do? You take that $6 billion difference and you put it on the balance sheet and you call it goodwill. And why do you need to put it in the balance sheet? Because balance sheets have this very unpleasant requirement, which is they have to balance. Why does goodwill exist? To make balance sheets. It's a plug variable. You'd be amazed how often I get emails from people saying, I have a company with 5 billion in goodwill. How much should I pay for it? To which my response is a plug variable. What the heck are you paying for? Every year I do send suggestions to the accounting rule writers, which they never seem to take. So about a decade ago, I sent a suggestion that we rename goodwill. In algebra, when you have two numbers that don't equate, what do? You say plus x. You can make any two numbers equal to each other. I said, let's call goodwill x. If you open an accounting balance sheet, you see goodwill, it sounds good, right? It sounds like there's stuff behind it. Let's just call it X. That way you'll never feel the urge to pay for it. Already you can see that when you look at the accounting balance sheets for a company, and from that you extract the value of equity in a company, because when you look at the shareholders' equity on a balance sheet, the classic book value of equity, you know what you're getting? You're getting a reflection of the company's entire history. It's the ultimate backward-looking number. So you took Coca-Cola and you look at its shareholders' equity, it includes the capital raised by Coca-Cola at its IPO. When was that? I have no idea, but it was a long, long, long time ago. Plus retained earnings every year. If you're writing it mathematically, that's what shareholders' equity. It's the ultimate backward-looking number. When you first look at a company, that's what you see, right? The accounting balance sheet. And already you can see why, with the rise of companies like Apple and Google and NVIDIA and Tesla, accounting balance sheets are losing their value. They're losing value because you're really learning nothing about a company by looking at its accounting balance sheet. So here's what I'm going to ask you to do. When you look at your company, you're going to see an accounting balance sheet. So this assumes you've picked a company, looking at the accounting balance sheet. I want you to, in your mind, start thinking about what I call a financial balance sheet. And at one level, it's far simpler than an accounting balance sheet. And another level, it's far more complex. You look at the asset side of the balance sheet, there are only two items, right? I don't divide the world into tangible and intangible, fixed and non-fixed. I divide into things you've already done as a company and things I expect you to do in the future. Things you've already done in the past, I'm going to call assets in place. Investments you've already made, and I'm going to put a value on them. Could they have a big value? Yes. For a company like Coca-Cola, what's in there? The original soda you created, the syrup, et cetera, all the beverages you've acquired, all the geographies you know. That's assets in place. The second item looks kind of mysterious, growth assets. That's a value I'm attaching to things I expect you to do in the future. Things you might not even have thought about yet. I'm giving you a value. See, why would I do that? We do it all the time. Talked about NVIDIA, 4.3 trillion. How much of that 4.3 trillion is for things they've already done? On a good day, maybe $500 billion. See, what about the other 3.8 trillion? Scary as it might be, this is what you're building in for things you expect them to do. Where? That magical AI space, right? People have to buy chips, and those chips are going to come from NVIDIA. And how are you going to run AI without those chips? And on Friday evening, we attached a value of 3.8 trillion, went to sleep. You slept through the entire weekend, you wake up on Monday morning. A lot of sleep deficit to overcome. What's changed? What does DeepSeek do? It basically tries to do many of the things that AI people claimed you could not do with powerful chips, with data that AI people said you need a lot more data. What's going to happen to the 3.8 trillion? You're going to reassess, right? The value of growth assets could go down, go up, things are going to happen. The nature of growth assets based on expectations of the future, and those expectations can change. It's dynamic. It's going to be different for different companies. What about Coca-Cola's growth assets? There's not much there, right? What are you going to do? Where are you going to go? You're already in every part of the world. Your beverage has kind of hit saturation point. And if anything, you could argue that maybe it's going to get less valuable over time. Maybe the sugar problem finally catch up with them. For Coca-Cola, the bulk of the value comes from investment already made. So one of the things to do when you look at your company, I don't care what company you pick, is look at where the value for your company comes from. You haven't put a number yet, but at least get a sense. Am I looking at a company, the bulk of the value comes from the future? Am I looking at a company where the bulk of the value comes from the past? Doesn't make one company good and the other company bad, but it'll give you a very different set of corporate finance choices as you move along. And in this financial balance sheet, what do you see as equity is not a historical number. It's always a forward-looking number. Could you be a company that invested $100 billion in the past and you're worth nothing now? Sure. I was reading about this company called Constellation Energy. I don't know, it's zoomed in the last couple of years. Why? Because it's been building these very large, because AI, at least in the story until Friday, was you need powerful chips, you need these centers, data centers that require immense amounts of power. And there's an ecosystem that's been built around. We supply the power to these AI. I wouldn't be surprised Constellation lost half its value today. Doesn't mean the market is crazy, it just means that expectations can shift. The value of equity in a financial balance sheet is a forward-looking number, and it can change at the drop of a hat. So I promised you the big picture. Let me deliver. I'll tell you up front, if you get this page, the rest of the class is icing on the cake. This is the only page that matters because it covers every core first principle in finance. And let's lay it out. I told you corporate finance is about any decision that a business makes that involves the use of money, right? But I'm going to classify those decisions into three buckets. You can have investment decisions. What are investment decisions? Projects you take, acquisitions you make, even deciding whether to put a water cooler in your is an investment decision. And the first principle in corporate finance is when you make investment decisions, make sure you earn a return on those investments that exceeds some minimum acceptable hurdle rate. That sounds like a buzzword, right? So for the moment, I'm not going to fill in the details, but I'll give you the sub-principle that governs how we think about hurdle rates. I know most of you might not be finance people, but tell me whether this at least makes common sense. The hurdle rate should be higher for riskier investments than for safer investments. Everybody agree with that? Now, I haven't told you how much higher. We still have a lot of work to do. Be high. And it should also reflect where you raise the capital. Did you borrow the money or use your own money? So the minimum acceptable hurdle rate should reflect the riskiness of the investment and how you raise money to fund that investment. You see, how do I measure returns? In corporate finance, returns should be based on cash flows. Already, let's pause there. As opposed to what? What is the entire accounting class's bottom line? What is the bottom line in an income statement? It's earnings. I'm saying, look, return shouldn't be based on earnings. Why? Because you can't spend earnings. That sounds mysterious. We'll come back and talk about it. Cash in, cash out, cash flows should reflect the timing of the cash flows. Would you rather get, would you rather get cash flows earlier or later? Somewhere, I mean, this is something we knew. I mean, with each of my kids, they're all grown up now. The age of 4 or 5, I had this test to figure out whether to put aside money for college. And this is usually right after they started getting their allowance. And usually they'd get their allowance on Saturday, and I would call each of them in and different points in time, and they say, would you rather wait till Saturday to get your allowance, or would you rather get it today, which is Monday? And here's the answer I didn't want to hear. They said, I'll wait till Saturday. I said, you know what, I'll take your college fund. Let's figure out something practical for you to do. You're not going. Thank God my first 3 kids all said, no, I'll take it today. My 4th kid, I knew I'd set extra money aside because here's what he asked. He said, is it the same allowance, Dad? That's time value of money, right? You wait till Saturday if I give you a higher allowance. That's time value. It's amazing how we dress this up and we forget the basics as we go along. But when you measure returns, those returns should reflect not just how much you get as cash flows, but when you get the cash flows, the timing. And there should be no side effects built in. There's no garnishing allowed in investment analysis. See, what are you talking about? Many of you have worked at businesses where you grind out numbers for an investment. You don't have to be a finance person. You're looking at an investment, you grind out the numbers, and the numbers don't fly. You know what I mean by don't fly? Investment doesn't look good. And then somebody in the room comes in with the garnishing. Like what? There are strategic reasons for this investment. Strategic is the most dangerous word invented in business. Basically means the numbers don't fly, but I really, really, really want to do this. There's an AI in this space somewhere. We'll be in China. These are garnishing. You're throwing them in after the numbers have been thrown in, saying, hey, we want to take this project. Can we find a good word to justify it? No, I'm not going to let you get by. My job is to take the big word and say, let's see what that means. I'm not going to dismiss your strategic considerations. I'm going to bring them into the numbers. Investment principle says, take investments that earn a return greater than your minimum acceptable hurdle rate. Of course, we have a lot to work to do, right? We have to measure risk and convert to a hurdle rate. We have to bring the mix of debt and equity, but that's why we have 25 sessions left of the class. Let's turn to the financing principle. The financing principle has 2 parts. I said there were 2 ways you can raise money, debt or equity, borrowed money or your own money. Which one should you use? I can't give one answer that applies to all companies, but here's what I can say. Find the mix that minimizes your hurdle rate. You see the advantage? You'd rather have a 9% hurdle rate than a 10 because it lets you take more investments. It makes your investments more valuable. What will that mix be? Again, a lot of work for us to do, but it definitely will not be the same for every company. And if you ask me, what kind of debt should I take? I'm going to turn the question back on you and say, tell me something about your assets, what you invested. I know you haven't taken the class yet, but I'm going to put you on the spot. And you're going to be my right? Don't look back. I'm looking at you. As I said, that's a problem. I have to point at you. Okay? I could do the laser, but I could blind you. So I know. I'll just let this. You ready? So you're going to be my advisor. I am an infrastructure company in Portugal. What kind of debt should I take? First, long term or short term? And why did you say very long term? Because I'm taking long term projects. And what currency should I take the debt in? So if I build a toll road and I collect tolls in euros, my debt, that was easy. I should use long-term euro debt. You know how many mistakes in corporate finance come from taking something simple and making it complicated? Okay. The rule in corporate finance is when you go out to borrow money in a way that the cash flows reflect the assets you're taking. Are there cases where you might have to make adjustments? Yes. You might be having an infrastructure project in Zimbabwe, and you might be unable to raise money in Zimbabwe because capital markets are not developed. You might raise your money in Europe or the US. You're going to get a mismatch, but at least you're aware there's a mismatch and you can do something about it. So financing principle says go out and borrow money and get a mix that minimizes your hurdle rate and match up your debt to your assets. And then there comes the dividend principle. And people lose their minds on it. If you cannot find investments that earn your hurdle rate, let's say your hurdle rate is 9%, the best you can do is make 7.5%. I've heard managers say, that's the best I can do. No, that's not true. There is another option, which is, what can a company do if it cannot find investments that make its hurdle rate? Give it back to the owners. If you're a private business, there's no glory in growth for the sake of growth, in surviving for the sake of surviving, or sustainability for the sake of sustainability. I'm going to pick on sustainability and other glorious words we've got into the business lexicon. If your core reason for existence is gone, just go away. Shrink. It's a dividend decision. If you're a public company, it gets a little messier, right? You can't just take cash out. You got to return the cash, and you said you can pay dividends. And until 1980 in the US, that was the only way you got cash back. But as we go through this class, you're going to see a trend that is well beyond pushing back on, which is increasingly, what's the other way in which companies give cash, return cash? They're buybacks. So already you can see the place. Buyback is just a version of a cash return that is different. We'll talk about why that switch has happened. It's pluses and minuses. But which one should you use depends on what your shareholders prefer, right? They're getting the cash. If I am Google and have a lot of cash, which one do you think they'd prefer to get the money in? Dividends or buybacks? You think so? You know, if you look at I mean, how many of you are investors in Alphabet? I call it Google still, or shareholders in Alphabet. You are a shareholder. Why do you buy shares in Alphabet? Because of the dividends you expected to collect on the stock? I wanted price appreciation. This is a stock I had in that segment of my portfolio where I said, I want this, which means the shareholders who self-selected to invest in Google did it because they wanted to get price appreciation. They didn't. In fact, I don't want to get dividends. You know why? Because April 15th is coming up. The minute I get dividends, I have to pay taxes on it. So if you're a Google and you have lots of cash, but if you're Con Ed or you are Citibank and you have a lot extra cash, you can't, then what should you do? Who holds shares in Con Ed and Citi? Probably, no, I don't want to may sound aged, but it's ageist, but it's probably either pension funds or 75-year-olds, right? People who want the cash. I'm not saying it's a bad thing. They buy these stocks for the dividend. There is no right answer. Should I pay dividends or buybacks? Look at your shareholder base. The answer is right there. And in doing all of this, in corporate finance, we have a singular objective. I'm trying to maximize the value of the business. That's a loaded objective. So how the heck do I measure value? What the heck is the business? That's the end game. And we'll talk about that. But this is the big picture. Everything in this class is tied to something in that big picture. So I'm going to use that big picture to bring home some core themes in corporate finance that are going to be pretty straightforward. First is, much of corporate finance is common sense. In fact, let's take the much out. All of corporate finance is common sense, because think about it. Many of you have never taken a finance class or a corporate finance class. Has any of the stuff that I've said so far surprised you? I mean, what have I said? If you raise money at 9%, please don't take investments that make 8%. I knew that already. So if you can raise money at 8% rather than 9%, use the 8%. You're saying, I knew that already. And if nothing I look at can make even that 8%, take the money out of the business. I knew that already. And that shouldn't surprise you. You know how old corporate finance is as a discipline? 67 years old. Can trace it back to a paper written in 1957 by Merton Miller and Franco Modigliani. Until 1957, corporate finance was the glorified accounting class. 67 years old. How long have people been running businesses? Definitely more than 67 years. Probably some very good cave business people. Their disruption was fire, never seen it before. This is the disruptive force. Or tools, extra sharp, right? Good business people it takes an incredible ego on the part of corporate finance people. Say, until we came along, you guys just were picking business, making these decisions randomly. Good business people through the ages have always understood these first principles. That's why you can be a great business person and not just not have an MBA, but never have gone to school. One of India's largest companies, Reliance, was founded by Dhirubhai Ambani, who was a fifth grade dropout. But an incredibly shrewd business person. You can bullshit him, right? You couldn't try the garnishing with him and say, you know what, this investment makes only 7%, our cost of capital is 10, but that's okay. Strategic. It'd have probably thrown you out of the office. Conversely, there are people out there with MBAs and PhDs who seem to have lost touch with these first principles. So here's my suggestion. Whenever we do something in this class that doesn't connect with you in terms of common sense, I want you to push back. Even if you if you feel too intimidated, push back in class. Come back and say, I don't quite get this. Because I want you to make that common sense connection, not just as an abstraction of this is the right thing to do, but this is why it's the right thing to do. Second, corporate finance is focus. One of my problems with any institution that doesn't have a focus is you're all over the place, right? And any given day, you're trying to do something different. It's nice we have focus. That focus comes from the central objective, which is maximizing the value of the business. And in some cases, with publicly traded firms, that gets narrowed down. We'll talk about why to maximizing stock prices. You know why in corporate finance we like that? Because it's observable. When you make a decision, I can look at the stock price effect. It comes with consequences, but that focus means everything we do in corporate finance, we can ask, what's the right way to do it? Because we know what the end game is. If you don't know what the end game is, how do you know what the right thing to do is? We'll talk about the pushback against this particular end game. You say, why maximize value? Why not maximize revenues or growth? We'll look at the alternatives. But everything in corporate finance is built around that end game because it tells us how to pick projects, how to fund them, how much to pay in dividends. But I think that every disagreement you and I are going to have over the next 15 weeks is not going to be about the mechanics, it's about the end game. So when you disagree with something corporate finance is doing, say, I don't like buybacks. Turns out that you might not like buybacks because you think businesses should have a different end game. I'm going to spend probably what you think will be a disproportionate amount of time on the end game in business. Why we chose the objective we do, what are the alternatives? I'm in a sense going to inoculate you against all the critiques you're going to hear about corporate finance in your other classes, because I think there are good arguments that can be made, but I will look at the counters to those arguments. I have 12 books. My 12th book came out in September of last year. It's called The Corporate Life Cycle. What does it do? It argues that businesses go through a life cycle just like you and I do. And businesses behave just like human beings behave. I'm not going to be mysterious. A startup is like a baby. Needs constant care and attention and lots of capital with a huge mortality rate. Why? Because 2/3 of startups don't make it to the toddler phase. You're a toddler company. You fall, you get up. You sometimes fall and don't get up. you're staggering. Your business model is shaky. Again, huge mortality rate. Let's say you make it to your teenage years. What do you do in your teenage years? What teenagers around the world do? I've had 4 go through my house, and here's what each of them did. They'd wake up in the morning, look in the mirror and say, I have lots of potential. What can I do today to screw it all up? That's a teenage mindset. Complaining about it doesn't make a difference because that's a teenage mindset. When I bought Tesla in 2019, I bought it because it was undervalued. But the post I wrote about why I bought it, I titled it My Corporate Teenager. You know why? Because it has lots of potential, but every morning one man gets up. He looks in the mirror and says, what can I do today to screw it all up? I buy the package. You take Elon Musk with all his dimensions when you buy it, good and bad, it's part of the package. You make it through your corporate teenagers, you're at the peak of your life. Enjoy it while it lasts. What does the peak of your life look like as a human being? It's when you can go to bed at 3, wake up at 6, and be a fully functioning human being. I don't even try that or think about trying that today. Enjoy the peak of your life because everything you touch turns to gold. NVIDIA, until Friday again, was at the peak of its life. What happened over the weekend? I mean, what my daughter has been not looking forward to this last year is she turns 30 in April, and she's convinced the world is going to end. You know why? Because after 30 comes middle age. It's such a doom-filled word, right? You're going to be middle-aged. Who amongst us says, I want to be middle-aged one day? But it's coming, right? And what happens with middle-aged companies? They've got to act like middle-aged people. Just don't overexert yourself. You might have a midlife crisis and buy a Ferrari. A company might have a midlife crisis and do a big acquisition, but guess what? A Ferrari doesn't make you 25 again. For a brief moment, you had that dream, but it doesn't last. But enjoy middle age, because after middle age comes even worse stuff. Like old age, and then after old age comes dementia, and after dementia comes you pass away. And companies go through the cycle. When you pick your company, one of the things I'd like you to think about, where in this life cycle is my company? Let's try this. Where do you think Apple is? Let's study. Where do you think OpenAI is in this? It's probably like a baby, but I'm not sure whether it's Damien from, it's like a baby, but a very terrifying baby, right? It could be have all these. Clearly, there's no business model here. It's a baby with very strange powers, and you're not sure what will happen next, right? What about Palantir? Where do you think you'd put it? What does Palantir do? Mysterious things with the CIA and the FBI. You're afraid to ask what it does because you might end up in Guantanamo Bay. But it's clearly a company with, a young company perhaps approaching the peak of its life. NVIDIA, we talked about, in the peak of its life, but that might pass. Every other one, if you look at most of the other Mag 7, you look at Alphabet, you look at Meta, they're middle-aged. They're good middle-aged. They've kept themselves in shape. Middle age is not always that's what I tell my daughter as well. It's not the end of the world. You can be Alphabet type middle age, or you can be Kraft Heinz type of middle age, right? What does Kraft Heinz do? 57 types of ketchup, all of which taste like crap. And cheese that stays liquid for the rest of eternity. It's a terrifying thought, right? But for a while, people loved it. But now its customer base is 65 and older. It's probably old age, and that old age comes with its own consequences. A couple of years ago, I valued Bed Bath & Beyond. Where would I put Bed Bath & Beyond in the life cycle? All you have to do is walk into a Bed Bath & Beyond, and Now, this was before they shut down. This is not long for the world. We're not even sure what you sell. It's a terrifying retail concept, right? You walk in, Bed Bath & Beyond. I should have looked at the Beyond first. There's bed and bath. I kind of get it. What is the Beyond? Whatever they want. Okay. And for a while, it was a concept that caught on. I lived in New Jersey for a long time. I no longer do, for lots of different reasons. But I lived a few miles away from the first Bed Bath, and it took off until it got to a point people didn't go in there. 2 years ago, I valued Bed Bath & Beyond. It was like valuing a corpse. There's nothing there. There's no real end game here. And there's nothing wrong with that. Business is if you tell me where you're in the life cycle, I'll tell you which principle you should be focused on. If you're Palantir, what are you focused on? Primarily the investment principle. How much can you borrow? Are you kidding me? You're losing money. What the heck are you doing borrowing money? First rule in holds is stop digging if you're in one. How much should you pay in dividends? Absurd. You can't be paying dividends. As you age as a company, all of those principles will start to evolve. I'm going to talk about the life cycle off and on in this class because it's amazing how much of what you see in a company can be explained by where it is in the life cycle. And when it gets dysfunctional, it's because a company is refusing to act its age. Okay? Intel throwing billions of dollars into the foundry business because they wanted to be like TSMC, or billions into AI because they wanted to be like NVIDIA. Company overreaching, trying to be something that they cannot be. And fourth, corporate finance is universal. In fact, it's unfortunate that there's the word corporate in the title, right? Because what does that lead you to think? What we're going to talk about applies to companies. It's not true. This is something that applies to all businesses, small or large, public or private, developed or emerging market. I have never felt the need to write an emerging market corporate finance book or a corporate finance book for doctors or a corporate finance. I mean, it's corporate finance of first principles apply. Are there estimation differences? Obviously. We're going to talk about how a private business hurdle rate might be different from a public company's hurdle rate. How an emerging market company, an Argentine company, because the constraints it faces might have to kind of alter the way but the principles don't change. Which brings me to the final theme, which is if you violate these first principles, somebody will pay. Maybe not you, but somebody will pay. I talked about people with MBAs and PhDs sometimes thinking the first principles don't apply to them. And then they act in accordance. It always ends up catching up with them or somebody else. Let me give you an example. It's an Indonesian taxi cab company in the 1990s called SteadySafe. I'm sure none of you have heard of this company. It's no longer around, and the story will tell you why. So early 1990s, Indonesia is booming. SteadySafe decides it's going to expand, which means what? Going out and buying more taxi cabs to put on. So you're going to be my banker. You want to be my banker? In this case, SteadySafe had a banker called Peregrine, but you're going to be my banker. And I'm going to ask you some very simple questions about funding this expansion. I'm going to borrow money to buy taxi cabs. Okay? What type of debt should I take? You're allowed to ask me back questions. So ask me the question you need to know the answer to decide on the terms of the debt. But in this case, cabs. How long do the cabs last, right? Let's say I tell you 10 years and then run them into the ground. The debt should be 10-year debt. What currency? Indonesian rupiah, 10-year Indonesian rupiah debt. That was a no-brainer. Let's play out what actually happened. SteadySafe went to an investment bank called Peregrine, a bank that's no longer in existence either. And they asked them this question, and they were told, take 10-year debt, but in US dollars. And they were given a very alluring reason. And what do you think that reason was? It's cheaper to borrow money in US dollars than in Indonesian rupiah. Very dangerous word to use cheaper. It is lower. The rate is lower. We'll talk about why they said it's cheaper. And SteadySafe listened to them. They went out and borrowed the money in US dollars. They fund this growth. And then to give SteadySafe credit, they went to Peregrine and said, should we be worried about the fact that we're borrowing in dollars to fund these rupiah assets? And the investment bank said, don't worry about it. The Indonesian government has pegged the exchange rate and promised us that nothing bad will happen. Famous last words, because in the mid-90s, the Indonesian government devalues the rupiah by 65%. So let's wake up to the morning after it's SteadySafe. What's happened to your assets? They're all rupiah assets. In dollar terms, they're worth 35% of what they were yesterday, right? If your debt had also been rupiah debt, it too would have been marked down. You wouldn't have been happy, but you'd have been okay. You'd have survived. But their debt is in dollars, their assets are in rupiah. So guess what happened to Steady Safe? They went bankrupt. And the only good thing that happened is they took their investment bank down with them. It happens far too infrequently, if you ask me, because they're always there at the wedding. They're never there at the divorce. Actually, they have two teams, a wedding lawyer and a divorce, but basically they make money on both sides. But just because Goldman tells you to do something that violates first principles doesn't mean that you're going to get away with it, or McKinsey. And I'm astonished sometimes at the advice that comes out of these places. And I said, that doesn't make any corporate finance sense. So the entire class, as I said, structured around that big picture. So you'll see, rather than a traditional syllabi, we're going to start with starting next session. About much of the session, going through session 4, we're going to talk about that objective. Why did we pick that end game? What are the alternatives? And along the way, we're going to talk about things like sustainability and ESG and stakeholder wealth maximization that I'm sure you've seen rise up to the surface in other classes, and why we don't go down those roads. Then we're going to spend about 8 sessions talking about hurdle rates, measuring risk, bringing to hurdle rates. 3 sessions on returns, followed up by a financing mix, dividend policy. And then we're going to go back to value and become more explicit about how do all these decisions tie into value. So I will see you on Wednesday, and get ready for an email, a really long email that will come exactly at 12:30.